Welcome back, everybody, to another deep dive.
Yeah.
You know, I used to think dividend stocks were kind of just for, retirees. But with all the market volatility we've been seeing lately, they're really starting to catch my eye.
It is interesting, that shift in perspective that you mentioned.
Yeah.
Historically, volatility would send investors running for cover,
Right.
but this time it feels different, wouldn't you say?
Definitely. It seems like people are looking for ways to kind of ride the waves, not just,
Mm.
avoid them entirely.
Mm-hmm.
So what's got, the folks over at Map Signals so bullish on dividend growers right now? We're looking at their article today, 3 big reasons to buy dividend growth stocks now.
Well, they kick things off with some pretty compelling historical data.
Hmm.
For instance, they point out that since 1930, the S&P 500 has returned an average of 10.4% annually when dividends are reinvested,
Okay.
compared to just 6.7% without them.
Wow.
That's a pretty significant difference,
Yeah.
especially over the long haul.
Especially over the long haul.
Hmm.
So, I love a good analogy. Would it be fair to say that reinvesting dividends is like that snowball effect, compounding, where those payouts generate even more payouts over time?
You nailed it.
Yeah, okay.
Imagine you're the listener just starting to explore dividend stocks. Think of it this way. Your initial investment is the tiny snowball at the top of the hill.
Uh-huh.
As it rolls down, collecting snow, those reinvested dividends, it grows larger and larger, gaining momentum.
Right.
That's the magic of compounding in action.
Okay, that makes sense. And Map Signals even gives us like a real-world example of this, right?
Exactly.
To illustrate it.
They highlight the fact that S&P 500 dividends have grown from $139 billion in 2000 to an estimated $585 billion in 2025.
Wow.
Year after year, that consistent growth really amplifies that snowball effect.
Okay, so we've got this historical backdrop of compounding working its magic, but 2025 is looking like a bit of a roller coaster, isn't it?
Yeah.
Tariffs, rising Treasury yields, AI uncertainty. It's enough to make anyone reach for the Dramamine.
It certainly feels like we're in for a bumpy ride. And all these factors are swirling around interest rates,
Right.
which can really rattle the markets.
Oh, yeah. Speaking of rattled, you can practically hear the VIX, that volatility index, screaming right now. It's jumped over 20% recently.
Yeah.
For someone who's new to this, what does that number actually tell us?
Well, think of the VIX as like a fear gauge for the market. The higher it climbs, the more anxious investors are about potential ups and downs.
Okay.
A 20% spike suggests there's a lot of uncertainty swirling around,
Right.
which makes a lot of folks nervous.
Yeah, understandably so. Okay, so we've got compounding on one end, volatility on the other. How does all of this make dividend growth stocks so appealing in this environment?
Well, if we look at the data going back to 1990, there's a clear pattern. Dividend-growing companies tend to outperform in volatile markets.
Interesting.
It's almost as if their consistent payouts offer a sense of stability amidst the chaos.
So they're like the steady Eddie in a room full of nervous Nellies.
Exactly.
Got it. But it gets even more interesting when the VIX spikes, right?
Absolutely. In months when the VIX jumps over 20% like it has recently,
Right.
dividend growers have historically outperformed non-payers by an average of 1.9%. It's almost as if they're built for this kind of turbulence.
Now, let's not forget about bonds. They've always been considered kind of the safe haven, the go-to for risk management in a portfolio.
Mm-hmm.
But it feels like their role is changing.
You're right. Bonds are undergoing a bit of an identity crisis.
Mhm.
While they still have a place, we have to acknowledge that we're in a different game now.
Right.
The bond bull market, which lasted for decades, has come to an end.
And Map Signals pulls no punches when they point out just how lackluster bond returns have been lately.
Right.
They mentioned that the Bloomberg U.S. Aggregate Bond Index, a key benchmark for U.S. fixed income, has returned a measly net 0.6% annually over the past 5 years,
Wow.
and a mere 1.2% over the past 10 years.
It's a bit of a wake-up call.
Yeah, for sure. So with bonds looking less and less appealing, especially with interest rates on the rise due to things like government deficits and political gridlock, are there any income-generating assets that could potentially step into their shoes?
That's the million-dollar question, and Map Signals suggests dividend growth stocks might be a contender, at least in part.
It's definitely an intriguing idea, but I know some people might be thinking, hold on, aren't high dividend stocks the same as dividend growth stocks? But there's a key difference, isn't there?
You're spot on. While both strategies aim to provide income, it's like comparing apples and oranges.
Right.
Dividend growth focuses on companies that steadily increase their dividend payouts over time, while high dividend stocks simply offer a high yield at a specific moment in time.
And Map Signals uses a really striking chart to illustrate the performance gap
Wow.
between these two approaches over the past decade.
Yeah.
The results are pretty eye-opening. The leading U.S. dividend growth index delivered a whopping 211% return, while the high dividend index lagged behind at 161%.
What's fascinating is the underlying reason for this difference. Dividend growth often signals a company's financial strength and its ability to generate consistent profits. It's not just about chasing that flashy yield, it's about investing in companies with solid fundamentals.
So it's more about quality and sustainability than just grabbing the biggest payout right now. That
Exactly.
makes a lot of sense.
And that's why Map Signals is so bullish on dividend growers, especially in a market where uncertainty is the name of the game.
Right?
Mm-hmm. And there's another factor fueling this optimism for dividend growth stocks. Map Signals predicts a robust 8.7% dividend growth in 2025.
Whoa, hold on. 8.7%. That's a pretty hefty projection.
Yeah.
Which sectors are expected to kind of lead this charge?
They're pointing to industrials, real estate, and financials as the sectors to watch. It's an interesting mix that suggests a potential cyclical upswing in the economy.
Okay, so we're not just talking about, random growth here. There must be some solid reasons behind this surge, right?
Absolutely. Map Signals has identified two key drivers behind this projected dividend growth. First, we're in the midst of record corporate profitability. S&P 500 earnings are expected to jump by 13% in 2025, which is almost double the long-term average.
So companies are flush with cash, giving them more flexibility to boost those dividend payouts. What's the second driver?
The second factor is that payout ratios are currently quite low. The S&P 500 payout ratio, which measures the percentage of profits used to cover dividends, is sitting at 36%, significantly below its historical average of 45%.
So there's plenty of room for companies to increase dividends without putting a strain on their finances. That's a reassuring sign for investors seeking sustainable income.
Precisely. This combination of strong earnings and low payout ratios creates a fertile ground for dividend growth. It's like a perfect storm, but in a good way.
Okay, so we've established that dividend growth stocks have a lot going for them. But how do we actually tap into this theme? Are there specific ETFs we should be considering?
There are a couple of popular ETFs that stand out when it comes to dividend growth. MapSignal specifically compares two Vanguard ETFs, the Dividend Appreciation ETF known as VIG and the High Dividend Yield ETF or VYM.
Hold on, wouldn't a high yield be tempting right now? Especially with bonds being so lackluster? What's the catch with chasing yields, and why does MapSignal seem to favor VIG's approach?
That's a great question. You see, VIG tracks the S&P Dividend Growers Index, which has a pretty strict entry requirement. Companies must have a history of at least 10 years of consecutive dividend growth to be included. It currently yields 1.7% and has a super low expense ratio of just 0.06%.
Those are impressive stats. But what about VYM? Does it have similar criteria?
VYM, as its name suggests, focuses on high dividend yields. However, it doesn't have the same stringent dividend growth requirements as VIG. It's more about the current yield and the consistency of growth.
So how do these two ETFs stack up against each other in terms of performance? Is there a clear winner?
Well, MapSignals uses a metric called MapScore to evaluate the attractiveness of different investments. VIG currently has a MapScore of 61, which indicates healthy institutional buying, but not overbought.
Interesting. And what about VYM's map score?
VYM has a lower MapScore of 59. This suggests that institutional investors might be less enthusiastic about its prospects.
Okay, so VIG seems to have a slight edge in terms of map signals analysis.
Hmm.
But what about their actual track records? How have they performed historically?
MapSignals provides a chart comparing the performance of VIG and VYM over time, and it clearly shows that VIG has consistently outperformed VYM except for a brief period in the recent past.
So it looks like consistently growing dividends might indeed be a more powerful strategy than simply chasing those juicy yields.
Hmm.
Now, you mentioned earlier that MapSignals sees VIG's sector allocation as another potential advantage in the current market environment. Can you unpack that a bit more for our listener? What's so special about VIG's sector mix?
You mentioned cyclical sectors earlier. Let's break that down for our listener. Cyclical sectors are those that tend to perform well when the economy is humming along. Think of industries like technology, industrials, and consumer discretionary. They rise and fall with the economic tides. Now VIG has a higher exposure to these cyclical sectors compared to VYM.
And why is that considered a positive in 2025?
Well, MapSignals believes we're heading for a Goldilocks scenario. They predict that growth will be strong, but inflation will remain under control. They also anticipate that those tariff fears will ease and the Fed will continue to cut interest rates. This creates a favorable environment for cyclical sectors to flourish.
So VIG's exposure to those growth-oriented sectors, tech, industrials, financials, and even healthcare is seen as a plus.
Exactly. And it's worth noting that VIG's healthcare exposure isn't just limited to those defensive areas like pharmaceuticals. It also includes more dynamic segments like biotech and medical devices, which adds another layer of growth potential.
That's a good point. It gives VIG a more diversified approach within healthcare. How does this compare to VYM's sector allocation?
VYM, on the other hand, has a higher concentration in less dynamic sectors like utilities and energy. These sectors tend to be less sensitive to economic cycles, which might limit VYM's upside potential in a Goldilocks scenario.
So if map signal's prediction about this Goldilocks economy plays out, VIG's sector allocation could give it a performance edge over VYM. It's like having a portfolio that's aligned with the prevailing economic winds.
Precisely. It's all about positioning yourself for success based on where you think the economy is headed.
You know, this has been a really fascinating deep dive so far, but I think what our listener really wants to know is why should they care about all of this?
Yeah.
How does this relate to their portfolio?
You're absolutely right. It's easy to get caught up in all these, interesting details. But I think the big takeaway here is this: in a world full of uncertainty and, constant market shifts, dividend growth stocks offer this pretty compelling mix.
Right.
You've got the potential for income, a bit of a cushion against that volatility and, the possibility for long-term growth.
Yeah, it's like the trifecta of investing, right? And
Yeah.
it sounds like we're really kind of moving beyond that old idea that, dividend stocks are just for retirees.
Absolutely. And Map Signals makes this really thought-provoking point at the end of their analysis.
Okay.
They remind us that some of the best performing stocks in history, the real legends, have been consistent dividend growers.
That's powerful. If those big success stories came from companies that, kept growing those dividends, maybe that's strategy worth considering for anyone, no matter their age or their investment goals.
Right. It definitely makes you think.
Yeah.
How might this knowledge influence your approach to investing? Could focusing on dividend growth be a key to building long-term wealth? It's worth pondering, wouldn't you say?
Absolutely. And I think, this deep dive has given us a lot to think about. And remember, this is just the starting point.
Mm-hmm.
There's so much more to explore.
Always do your own research, look at different perspectives,
Yep.
and figure out what aligns best with your own, financial goals and risk tolerance.
Couldn't agree more. Thanks for joining us on this deep dive into the world of dividend growth stocks. We hope you found it informative and maybe even sparked some new ideas. Until next time, keep learning, keep exploring, and keep asking those thought-provoking questions.